You can win 3 trades in a row by pure luck and start believing you figured something out. That belief is dangerous. Fast profits without understanding create a destructive feedback loop. Overconfidence leads to increased position sizes and skipped rules, keeping the gas pedal down until the market violently corrects the illusion. The market doesn't owe you anything. It is a strict probability game played over hundreds of trades. In your first year, mistakes are mandatory. Every single trader makes them. The only variable is how much those mistakes actually cost you. Walking in expecting fast money leads to rushed fundamentals and risks you don't understand. Your actual goal in year 1 is to survive long enough to learn how the game is played. We don't expect a surgeon to save every patient. We judge them on their process, their training, and their decision-making under pressure. Trading works exactly the same way. The financial outcome of one specific trade tells you almost nothing about the quality of your decision-making. Every forced trade actively drains a second, hidden account that doesn't show up on your broker's dashboard: your mental capital. This is your psychological state, the objective clarity required to execute without hesitation. Raw willpower cannot protect that capital. Willpower is exactly the resource that evaporates the moment you take a painful loss and feel desperate to win it back. True discipline must be architectural. Your rules need to be hard, defined, and non-negotiable. If your system requires 5 specific setup conditions and you only see 4, you wait. No exceptions. If your rule says you stop after 2 losing trades in a day, you stop. Win or lose after that limit, you close the laptop and step away from the charts. Protecting your mental capital through these architectural rules is the only way to maintain the clarity needed for execution. Even a stable mindset fails if it's paired with a broken technical strategy. To survive, you need a mechanical edge. Most amateur traders draw boxes anywhere price reacted in the past. But a zone isn't valuable just because price touched a random level. It's valuable because one side took control from there. Origin zones are tight bases where buyers seized control to break a structural high, drawn strictly around this launchpad. A retest zone is different. Price breaks a resistance line, returning to test it as new support. It's a breakout level, not the source. Before trading either zone, check the higher time frame. A perfect lower time frame zone is a trap if it fights massive macro pressure from above or below. A scientifically drawn zone doesn't guarantee a win. It simply dictates exactly where to look for a high probability fight. Placing a limit order the moment price touches your zone is dangerous. You are entering before the market proves that anyone is still defending that area. Stage 1. Downward momentum weakens, forming smaller bearish candles with long lower wicks. Stage 2. Price compresses into a tight sideways dispute. Stage 3. The dominant side takes control, closing decisively outside the compression. The entry trigger appears only after that candle completes. With the setup confirmed, place your stop-loss invalidation below the lowest point of that confirmation sweep. This protects your capital if the market suddenly shifts. Demanding this 3-stage confirmation drastically reduces trade frequency, but it exponentially increases the quality of the trades you keep. The market offers zero certainty, only probability. It can act entirely irrationally, and even the best setup can set up fail. Every trade is an independent event. A coin doesn't know it just landed heads 7 times in a row. Past winning streaks have zero mathematical influence on your next setup. Improvement requires a growth loop. Execute, review, fix, repeat. After every trade, record exactly why you entered, how you felt, and what you learned. Without an honest review, you are destined to repeat your mistakes. Identical risk sizing on every trade prevents a single loss from wiping out weeks of gains. This chart shows how an edge actually works. It isn't a straight line. There are frequent drawdowns. But by trusting probabilities over a massive sample size, the mathematical edge materializes. Success is not achieved by outsmarting the market. It is achieved by building a mechanical, emotionless system and executing it flawlessly over time.